there can be a huge reality gap between, let's say, our understanding of what it means, of what probabilities mean. Like, saying, hey, our pattern gives us an edge, over a series of trades, over a series of 10 trades, 7 are going to be winners, 3 are going to be losers. The problem is we don't know which ones are going to win and which ones are going to lose. So if I'm going to actually extract the profit potential in that edge, it requires that I be able to take every single trade in the series or the sequence without making errors. Makes sense, right? Okay, understanding that and believing it at the core of your personality so that you can actually do it are two completely different things. We can say we can think of ourselves as a probabilistic thinker. Say, yeah, oh yeah, I get it, I understand it. But if you can't execute all 10 trades flawlessly, then I can guarantee you, you can't function at a probabilistic perspective. Because when you can, you will be able to lose without thinking you're a loser. You will be able to be wrong without thinking there's anything wrong with you. Because that's in essence where we're going. This is what makes trading so hard. We live in a society that's completely obsessed with winning is everything. Avoid losses at all costs. Winning is everything. Avoid losses at all costs. These are very powerful belief systems. You think they're just going to go away and not assert themselves on what you do and how you behave just because you have this understanding in probabilities? Just because you might read a book or go to a conference, say, hey, you know what? This is a probabilistic environment that we're dealing in, and you got to think in odds. Oh yeah, oh, that makes sense. I can see that. Try doing it. Because what you do is going to be a function of what you believe. And if you can't do it, it means that there are conflicting beliefs that say that, you know what? No, this is not right. I think my analysis should tell me what's going on. And even though at a conscious level you're thinking, no, that's not what this is all about, it doesn't mean that that energy isn't asserting itself on how you behave. Otherwise you wouldn't be afraid. You were at the casinos last night. How is it that if we lose, it taps us into, we have a losing experience, it can tap us into all the accumulated negative energy, like I put yesterday, of what it means to lose in our life. Losing has the potential to tap us into all this negative emotional energy. I don't want to feel that way. Most people with, let's say, a normal psychological makeup also don't want to feel that way. We will avoid this at all costs. I don't like the feeling of what it means to be wrong, all the negative energy. Brings up all the times we're berated as kids, someone ridiculing us, teachers, coaches, whatever. So if my trading experiences have the potential to tap me in to these two belief systems, or these memories, the memories of what it means to lose and what it means to be wrong, well, you know what? I've got big problems. Because you know what? If I can't lose and I can't be wrong without it resonating, negative emotional energy, there's only one other way that I can think of to help me avoid tapping into all this, and this through analysis. So in one sense, we're going to say, well, I'm a trader, which means I'm a risk taker. But the reality is we're using analysis to do everything to avoid tapping into the memories of losing and the memories of what it means to be wrong. And it doesn't work. What we're trying to tell you is this doesn't work. because there isn't any analytical regimen or system that you can come up with that will guarantee that the next trade is going to work. What technical analysis does is it defines patterns. In other words, when we got the order flow, we got buys coming into the exchange, we got a flow of sells coming into the exchange. When there's an imbalance between the buys and the sells and there's no buys, the price has to tick up. When there's an imbalance between the sells in relationship to the buys, the price has to tick down. As these price up and down, as the price ticks up and down, up and down, up and down, up and down, it creates what we call collective behavior patterns. I say collective because everyone who submits an order to the exchange contributes to the pattern. And what we found is that not only can these patterns be identified, quantified, but they repeat themselves with statistical reliability over and over and over again in every time frame. You guys with me on this? Where's the problem? What? Go ahead, Tony. Oh, well, yeah. No, the problem is the patterns repeat themselves over and over again with statistical reliability. The outcomes that the patterns are predicting are random. I want you to get this. This is big. Okay? The patterns repeat themselves with statistical reliability, but the outcome that the pattern is predicting is random in relationship to the previous outcomes. There's a completely random distribution between wins and losses over a series of edges, or the criteria that define your edges. Exactly. That's right. That's how casinos make money. They're gambling on each individual. They know that it's a gamble. Each individual outcome is unpredictable and unknowable. But over a series of events, the law of probabilities will work its magic. And they don't need to worry about the outcome to each individual event. So now you tell me, nobody likes tapping into the pain. No one likes tapping into the pain. And yet walk into the casino and watch people sit in front of a slot machine for hours and pump money into that machine knowing they're going to lose. Not only knowing they're going to lose, experience losing. And why is it that they're not experiencing emotional pain? They are losing. Why aren't they experiencing emotional pain? Well, it's one at a time. Somebody raise their hand. Whatever. Go ahead. Yeah, let's put it this way. You say they're expecting the next one. They don't know if the next one's going to be a winner. The next one may be a winner, and the whole idea of it being fun is because they're going to be surprised if it is. But the point is, they are expecting wins and losses. As a matter of fact, if you watch somebody play slots or you experience playing slots, you know that you're going to lose more times than you win. And as long as you accept the risk, meaning, and how do you know you accept the risk? Your behavior will tell you accept the risk because you don't have any problems putting the money in the machine. See, if you couldn't accept the risk, then you would find it difficult to actually put the money in the machine. Gambling forces us to accept the risk in advance because if we don't, we can't play. You can't sit down at a blackjack table and just decide to play and without putting your money out there first. They won't let you. But the illusion that analysis creates with trading is that I can actually get into a trade and believe that I'm not taking any risk. And if the market happens to go in my favor immediately without giving any heat, it reinforces the idea that yes, I can do this without risk. I can do this without risk. I don't have to experience this if I just find the right method. That method doesn't exist. Get it in your brain. It doesn't exist. If I had a method that produced 99% winning trades, I guarantee you, if you're risk adverse and you haven't accepted the risk, you will not make consistent money. You'll always be worried about that one time. That's why, like you take a trader who, has, 9 out of 10 winning trades, maybe 4 or 5 or 6 or 7 in a row, and you're talking to other traders at conferences and chat rooms, and they'll tell you about all these winning trades that they had. They didn't tell you that the 10th trade they lost all their winnings on the first 9 and more. They didn't tell you that. Yeah, 9 out of 10, 9 out of 10, yeah. And did they have to lose all their winnings from the previous 9 trades? Did it put a stop in? No. Did it define the risk in advance? No. And why didn't they define the risk in advance? Why did they not put a stop in the market? Because they thought they had a guaranteed win. It's that simple. Do you think that people could sit there and play slots for hours if there was the emotional risk? If there was the emotional risk that traders have about if they're wrong or they lose, they're going to tap into that pain. We don't enjoy that. It has to be enjoyable. The emotional risk of playing slots for most people just doesn't exist. They're enjoying themselves because they know the outcomes are random. They know they cannot, it is senseless, it would be an effort in absolute futility to think that they're going to predict what the pattern of those wheels are going to come up with on the next spin. They might not know anything about the architecture of the computer chip that generates the random outcome, but the point is, it is a purely random outcome. And when we learn that it's purely a random outcome, the whole idea of predicting or even being right or wrong is irrelevant. It doesn't apply. Does not apply. And so it takes what we're doing, the activity, out of a right or wrong context. And so I can sit there and push the button, and there's nothing to be right or wrong about because I'm not predicting the outcome. Now, that's a little bit more tricky in trading because we're using an analytical process to actually make a prediction. But what we have to do is we have to apply the principles of the law of probabilities on that prediction and say, you know what? This is a prediction, correct. Okay? I mean, this is, yes, I am making a prediction. I don't have any illusions about the fact I've used this in an analytical process. I've come to a conclusion. I'm making a prediction. But you know what? It's still just a guess. And in that way, we're not responsible for what the market does after we put on a trade. How can we be? When you understand order flow, when you understand there is no way that I can predict the intent that other traders have after I get into a trade. There are other traders all around the world waiting to enter orders for whatever reason pops into their brain. Whatever agenda they have, whether it's commercial, whether it's contractual, whether it's hedging, or whether it's pure speculation, they have their reasons for sending a buy or a sell order to the exchange and how big that order is. There isn't anything that we're doing from a technical or even fundamental perspective where the mathematics of our system can predict what those guys are going to do, or women, okay? There's just no way. In essence, I'd have to know who's about to send an order to the exchange, what kind of orders are going to be. Is it going to be a buy or a sell? How big is it going to be? And then with that, you could say, okay, well, we've got all these buys coming in, we've got all these sells coming in, and so in this moment right here, we should get an uptick. But then again, let's say in the moment there's a huge abundance of buy orders coming into the exchange that overwhelms the number of sell order inventory to take the other side of those trades, and the market starts to shoot up. But then some other trader somewhere in the world sees the opportunity to what he thinks is sell high and just slams that rally with a huge order. Now you would think, well, who could trade that big? Well, hedgers can trade that big because they're not taking the risk. They're eliminating the risk. They're already long or short. They're already what I call naturally long and short based on their business. So yeah, they can put that big of an order in the market and actually defend a price. You heard words like defending a price? This is what it means. You tell me how a mathematical equation is going to predict that. Somebody please. But that's exactly the way you trade, isn't it? Isn't that exactly the perspective in which you take? You think that this mathematical equation is going to accurately tell you every single time what the intent of all these other traders are around the world? It's just a probability game, everybody. That's it. And analysis makes us think it's something else because of the erroneous and connections that we make and erroneous assumptions that we make. It's like, yeah, okay, again, I've said it again. I did my analysis. I made a prediction. The prediction was absolutely correct. So the reasons why I made the prediction must be the same reasons why the market went in my favor. And that way, I knew what was going to happen. I knew what was going to happen. Making us think that the risk cannot exist. If you're trading to avoid being wrong, if you're using analysis to avoid being wrong in any capacity at all, even just the tiniest bit, if you're using analysis to avoid being wrong and avoid losing, it doesn't work. The only way you're going to make this work is to adjust the way you think, is to change your perspective, that what you're doing doesn't have anything to do with, you're going to need, your predictions have to be correct, but your reasons for making the predictions do not. In most cases, for the typical screen-based trader, most of the trades they put on, there is virtually very little correlation between the reason why the market went in their favor and the reason why they put on the trade. Very little correlation. And what do I mean by correlation? How would I find that out? I would have to be able to inventory if I went long based on a moving average, and my moving average crossed, and I put a buy order in the market, and then 3 or 4 minutes later the market started rallying, and I'm thinking that okay, that's well, I have the right reason for making this. My technical reasons must be be correct, because it made the correct prediction. I would actually have to go out and determine all the traders who put buy orders in the market that actually caused my trade to become a winner, because I couldn't make my own trade become a winner. I can't trade at a level where, for an example, if, and there are a lot of traders who can, a lot of traders who have strategies to do exactly this, okay? That when they see how many bids and offers there are, at certain price levels, at certain significant reference points that they know they might be able, like I said yesterday, like stampede people out of a position or even into a position that helps them out, okay? All they have to do, if the price is at 10, all they have to do to bid it up to 11 is just simply take out all the offers. If there's X number of offers at 11, all they got to do is hit them. That's it. And the price automatically goes to 11. Then all they have to do to get it to 12 is hit all the offers again. That's it. They're actually creating their own price movement. They know why the market's moving. They know why it's moving, because they're doing it. And they are making their own trades winners, because everyone who took the other side of their trade at 11, when it gets bid up to 12, is a loser. Everyone who took the other side of their trade at 12, when they bids it up to 13, is a loser. Now, this can be a dangerous strategy. You have to have a lot of capital and a lot of balls, because as their position size grows, for them to get out of that trade, what do they have to do to get out of that trade? they got to reverse everything. In other words, they have to become sellers, which means that if they have a huge position that they built, a huge long position they built up, there has to be buy inventory for them to get out of that position. In other words, they become sellers, and if there isn't enough buy inventory for them to get out of that position, they can actually force the price right back down again. What's what they, well, you know, hey, yeah, it's like, right. You know, there's a very famous guru on TV, I'm not going to mention his name, but about 6 or 7 years ago, he was doing an interview on the street, as a matter of fact, and kind of bragging, actually, before he became really, really famous. And he talked about a strategy, and this is something it's probably still done. I don't watch the markets enough to really say, but you know, it's like if you watch to see what kind of orders are flowing, the size of the orders that are flowing into the exchange towards the close. So let's say we've been in an uptrending market, and it's like retail traders who need the most confirmation. They're the most risk adverse, so they need the most confirmation that something's going to work. Okay, so to get into a trade. So this is a particular stock, for example. So they see a lot of 50 share, 100 share, 200 share orders flowing into the exchange on the close. What do they know? They know a lot of retail people are buying into the whole idea, right? So what they're going to do is, you know, they're going to see what kind of bids and offers are lining up before the close or before the open the next morning. And he would say, hey, you know what, depending on the stock, he might have to allocate, you know, anywhere from $30 to $50 million to take out all of the bids. So let's say the market is slated to open right here. He might allocate $50 million or whatever it took to take out all the bids to drive the price down in the open, at the open. And all those, not all, but many of the people that bought on the close the previous day, this was the close the previous day, they're going to think, oh my God, what did I do? They're going to start selling, okay? Their sell orders are now going to help create this downward movement because there's an imbalance between the number of the buys and the number of sells. And as soon as they start coming into the market with their sell orders, he reverses his position and starts taking the other side of those sell orders as a buyer, so he was able to get in on this trending market, for an example, at a lower price. So you just force the market lower, he gets in at a much lower price, and then the market just reverses back up again and keeps on going. This is a valid strategy that people have been using for years. I mean, this doesn't surprise anybody, does it? So it's like you got to be able to do this. You got to be able to do it. You got to be able to you know, get yourself into an emotional state of mind, like a person who's playing a slot machine. It's like, how do I lose without feeling like a loser? Real simple. You're not losing. This business requires expenses. Now, you're laughing, but it's true. You think that's the way? You think the casinos, the board of directors and the management of the casinos, when you know they're looking hand by hand, they say, "Oh my God, we just lost $1,000. Oh shit, we just lost $5,000. What am I going to do here? What am I going to do?" These are expenses. The amount of money that we pay for the trade, the edges that don't work, is simply the cost of doing business to make ourselves available for the trades that do.